Most of us think about a country's wealth and its currency as being kind of the same thing. But what if we've got it all backwards? What if the real story is how a nation's economic health actually creates the value of its money? It's this incredible puzzle that once you see how the pieces fit together, completely changes how you look at the global economy. Let's dive in. So, let's just kick things off with a simple question. A weak currency, is that a good thing or a bad thing for a country's economy? True or false? Now, you probably have an answer that just popped into your head, but I guarantee you the reality is so much more fascinating. Yeah, the answer is definitely not a simple true or false. It's this constant push and pull, a sort of hidden economic engine that connects these massive global financial markets right down to the price you pay for, well, everything. Today, we're going to pull back the curtain and see how that engine really works. All right, first up, let's tackle the conventional wisdom. You've probably heard this one before, the idea that a country can just weaken its currency to solve all its economic problems. Sounds easy, right? The logic seems pretty straightforward. If your country is buying more stuff from the world than it's selling, that's a trade deficit. The simple fix seems to be, hey, let's just make our money cheaper. The hope is that this one little move will magically rebalance the scales. But how is that supposed to work exactly? Well, it really boils down to three forces that are all fighting against each other. The first two are what we call volume effects. On one hand, your exports get cheaper for everyone else, so you start selling more. Great. On the other hand, foreign goods get more expensive for your citizens, so they start buying less. Also good for your trade balance. But then there's the catch, the value effect. The price of every single thing you import goes up, and that happens instantly. And that, well, that hurts. So, the big question is, which effect wins out? Economists actually have a name for this exact tipping point. It's called the Marshall-Lerner condition. Don't worry about the name. Think of it as a simple rule. For a weaker currency to actually help, the good stuff, selling more exports and buying fewer imports, has to be strong enough to overcome the immediate pain of everything you import suddenly costing more. And does this actually happen in the real world? Well, yeah, for many developed economies it does, but only in the long run. Take a country like France, for example. The data shows that, over time, the positive effects of selling more of their goods to the rest of the world does in fact outweigh the sticker shock of pricier imports. But the key word here, and you're going to see why this is so important, is eventually. And that brings us to our next huge idea. When it comes to currency, timing is everything. This is what's known as the J-curve effect. And here's why that timing matters so much. The pain is immediate. That value effect, where everything from abroad suddenly costs more, it hits your wallet today. But the good stuff, the volume effects, where people and entire companies actually change their buying habits, that takes a lot more time. I mean, you have existing contracts, supply chains. You can't just switch on a dime. It's a really slow adjustment. This delay is what creates that classic J-curve shape. Right after you weaken your currency, your trade balance actually gets worse because of those higher import costs. That's the dip at the beginning of the J. Then, slowly, as people start buying more of your now cheaper exports and fewer of those expensive imports, the balance curves back up and hopefully improves. It literally gets worse before it gets better. But wait, it gets even more complicated. What if the prices consumers see don't really change all that much? Think about it. If you're a big international company, the last thing you want is to lose your customers. So if a country's currency weakens, you might just absorb that price change into your profit margin instead of passing on the savings. You keep your customers happy and you pocket the difference. This is a huge deal, and it can seriously blunt the whole effect of a currency change. Okay, so trying to just manipulate your currency to fix your economy is, well, it's messy. It's unpredictable. But what if we've been looking at this entire thing completely backwards? What if the currency isn't the cause of economic change, but the effect? We've been asking, how does a change in currency value affect the economy? But the much, much more powerful question, the one that really gets to the heart of how this system works, is the complete opposite. How does the fundamental health of an economy change its currency? To get this, we need a new tool in our toolkit. It's called the Net Foreign Asset Position, or NFA. Just think of it like a country's personal balance sheet with the rest of the planet. It's all the stuff its citizens own abroad, minus all the domestic stuff owned by foreigners. It tells you, very simply, if you're a creditor nation or a debtor nation. So why is this NFA number so important? Because it's basically a giant flashing sign for global investors. And believe me, it's their decisions, their perception of risk and reward that really move currencies. I mean, put yourself in an investor's shoes for a second. You have two options. Country A is a debtor nation. It owes the world more than the world owes it. That feels kind of risky, right? To get you to invest there, they'll probably have to offer you higher interest rates. Then you've got Country B, a creditor nation with a big surplus. That looks a whole lot safer. Investor demand is just naturally going to be higher. So over time, which way do you think the currencies will go? Money flows to Country B, strengthening its currency, and flows away from Country A, weakening its currency. And this isn't just a theory. Take a look at the real world. Let's look at the data from the 1990s. On one side, you can see the United States' NFA position getting worse and worse. They were becoming a bigger and bigger debtor to the world. And at the exact same time, you see Japan's NFA position steadily improving. They were becoming a bigger creditor. And what happened to their currencies? It's almost picture perfect. As the US became a larger debtor, the US dollar's real value went down. And as Japan became a larger creditor, the Japanese yen's real value went up. The underlying economic reality, their net wealth, was actually driving the value of their money. And boom, there it is. That is the hidden feedback loop. It's not that weakening your currency magically fixes an economic imbalance. It's that the imbalance itself, a country's net wealth position, eventually and inevitably forces the currency to adjust. The currency is the symptom, not the cause. Okay, so this is all really interesting, but why does it matter to you and me? Because this giant global mechanism has a very real impact on our local economies, right down to the price of a haircut. To understand how, we just need to split our economy into two basic parts. First, you have tradable goods, things like cars, electronics, oil, stuff that can be put on a ship and sold anywhere in the world. Then, you have non-tradable goods and services, things like haircuts, construction, healthcare. You have to produce and consume those right where you are. And this is the final mind-blowing piece of the puzzle. A country's real exchange rate, it's not some abstract number cooked up by traders. What it fundamentally represents is the price of all its local non-tradable stuff, like haircuts, relative to the price of global tradable stuff, like a car. So when we say a currency is strong, what we're really saying is that its local services are expensive compared to the rest of the world. Okay, so let's pull all of this together. What are the big takeaways? First, a country's deep economic imbalances, its net wealth, is what really drives its currency value over time. Second, trying to shortcut that reality by just devaluing your currency is a painful and unreliable fix because of things like the J-curve. But here's the most surprising part. The way for a country to really improve its economic standing isn't necessarily by focusing on global trade. It's by looking inward, by making its local, non-tradable services more efficient and competitive. If you can make things like construction and healthcare cheaper and better, you strengthen your entire domestic economy, which in turn reinforces the true value of your currency on the world stage. It's a powerful, counterintuitive idea. So we'll end with this question to chew on. If the true strength of a currency comes from a nation's underlying wealth and domestic competitiveness, not just clever trade policies, what does that tell us about the future of the global economy and the shifting power dynamics we're all about to witness? It's a lot to think about.